We think the new generation of activity looks like it's centered around event trading. I know that sounds kind of weird, but if you think about everything that we do in life, it's centered around events. Like we see our kids on holidays, we go to certain events to see stuff, to do things. I was out the other night and I went to an event. You know, I didn't really even know it was called an event, but it was somebody's birthday party, so it was an event. So we do these things that are centered around events. It becomes kind of the focus point for, so I think trading is becoming the same way. We used to focus trading around expiration cycles, and now we're starting to learn that there's almost more opportunity centered around binary events or just something happening. Like, for example, last Wednesday was an event. It was the Fed number. Over the weekend, there's an event. Apple delivers its numbers, or some other measure, an election in Germany. That's an event. So what we're starting to see is a lot more focus on events. When we were trading actively as prop traders or professional traders, we had very little focus on events. Events were all pre-scheduled, and with the dissemination of news back then being very organized, there was very few, quote, events.
An event was a broker coming in with a large order.
But I mean, there was very few like events scheduled outside of certain times. Like maybe once or twice a month there would be an event, and earnings were a non-event because nobody traded earnings. Now what we're seeing is much more commitment to opportunity rather than commitment to buy and hold. So listen to this segment. It gives you a lot of detail on this, and then we'll get into other stuff right afterwards. What is considered a binary event? Well, it could be earnings, quarterly intervals, Fed announcements, interest rates, or other monetary policy adjustments. Specific sectors passing of new laws, stock-specific special announcements. So
listen, Apple this morning was a great example of a binary event, one that you didn't know about.
No, it wasn't, because you couldn't trade it. Like if you don't know about something, you can't. It wasn't. There was no measure. So here's the distinction. There's a lot of opportunity. A lot of people will say, "Hey, there's a lot of unusual option activity, so therefore we're going to trade a certain stock." There was no unusual option activity in Apple on Friday. In fact, if you watch the Apple volume and even the turnaround and everything else, it was very normal. It was under the averages and underperformed the marketplace on Friday Apple activity. And then today they have this. So there's no correlation. At least we found no correlation between option activity and some pending up move or down move. But we have found is there's a correlation between
volatility,
a known event, volatility, and volatility contraction. So we feel like one of the ways to, an example last week was the Fed's coming out with numbers on Wednesday at 1 o'clock. Anything you sold premium wise prior to 1 o'clock Central Time or 2 o'clock Eastern Time made money even with the rally. So they rally up 15 points from there, and every position, as long as any delta neutral position, made money.
So when you say selling, you mean selling both sides, right. Selling premium.
Right. That's taking advantage of, quote, a binary event. Not with respect to Apple this morning, there's no way you know what's going to happen, so there's no event to take care of. Again, the takeaway from this is that most people in this industry think that there's some indication that what happened today in Apple was easy to see, when the reality of it is there's no way you would know.
And I agree with you there, but let's take one step further. I mean, regardless of what the news might have been, if Apple was trading 500 and change, this stock might not have had too much of a move. It also goes again to price, right? The news validating the price of the stock. The stock had gone from $510 down to $450. I know
Sure.
It was mid-range at $480. Now it's back up to $493.
If there's a great takeaway from Apple, it's that if you sold into the rally and bought into the dip, it worked.
Again,
that's your whole takeaway. Let's go next slide. So what are some of the factors of a binary event that affect our own trade decisions? Because what we're learning is these so-called binary events create, this quick statistic, weekly option trading right now accounts for over 25% of all option activity. Now, the crazy thing about that is that a few years ago, there weren't weekly options. But the difference, what we're learning is that the reason that people trade weekly options is because they want that binary effect. They want that instant gratification, but they actually don't know when to take risk and when not to take risk. So people are becoming a little bit disenchanted with derivatives because of they want the instant gratification of weekly options, but they're not trading them when the implied volatility suggests that there's any edge whatsoever. So what we're seeing is a interesting product creation, but kind of not working the way it was intended, or maybe not intended, but not working for individual investors because they're only trading them because there's a short period of time till expiration. They're not trading them because they actually know what they're doing.
Sure, and you can see that, and I'll just put up that Apple volume here for you. You can see that reflected in all the volume that you see in the weekly options.
So what are some of the factors of a binary event that affect our trade decisions? First is direction, 50-50 probability of success. Second is magnitude, consider the expected move, look past the earnings move, and volatility, anticipated reversion to the mean pre-earnings. So there are certain, we traded the earnings last cycle, and there were about 10% of the stocks that we traded got out of control. So, which means that about 10% of the stocks that we traded last earnings cycle, we couldn't control the after effect of the earnings. Facebook, for example, there's a CRM, there's a couple different stocks. I think there was maybe it's closer to 15%. There were about 5 or 6 stocks out of just close to 40 earnings stocks where we couldn't control the amount of the move because the stocks just got away from us. There were about 30 stocks where we were able to get out the next day, and there were probably, let's say, another 15% of the stocks where where you could defend the position. Now, when you think about that, say there's 40 earning stocks, and we played all 40 earning stocks, and say that of the 40 earning stocks, if you look at 15% of 40, it's 6. So, and you think about one standard deviation on both sides is 6 and 6. So of the 40 earning stocks we played, 30 of them were winners and or very manageable, and that's exactly what it should have been, 28 out of 40. 15 we were able to defend, and 15% or 6 were able to defend, and 15% or 6 we weren't able to defend. It goes directly to the percentages. It was actually exactly what was supposed to happen. Now, the cool thing about that is we're able now to look back and first figure out, was there something we could have done different on the ones we could defend? But second, we look back at that and say, hey, here's a trial sample this quarter of 40 different stocks, which gave us 40 different events to trade. And the reality is it worked just the way it's supposed to work. And net in the end, were we up money? So net in the end, the answer is we were up money, and even
that's a differentiator, right? You do this to make money. There's no other reason to do it. Well, the numbers are going to work out for the numbers.
The hard part for individual investors, the really tough part is when you look at a situation, like an earnings cycle, it's very hard for you guys, I think, to differentiate between a big loss and a profit. So in other words, you'll think of the last earnings cycle and you'll go, I got killed in XYZ. But it's very hard to look at all the different stocks as a total. And so the totality of it is, did I make money on the whole thing? Because that's the way I think we have to look at it in order to be successful. And that's a very hard situation. Like, I'm trying to get Case there, but she's nowhere close. And looking at the totality
but she could pick market direction, so it doesn't matter.
That's right. But looking at the totality of the whole situation, that's what it is. Anyway, so let's go next slide. I'll go through this faster, I'm sorry. Does the management of binary effects of events trades differ from other strategies? Normally, duration is the key component to our strategy. The reason duration is a key component is because what we're betting on is some contraction in volatility over time. The binary event, we can close out the next day in our minds because all it does is speed up time. So that's why we love them so much, because we get to everything that we would see over the course of 30 days, we can see over the course of a few minutes. We understand the risk, the corresponding risk with that. It's just, again, we're trying to justify an approach to a certain way of trading to help us kind of accelerate the learning process. We actually believe, and we're going to talk about this a little bit, we actually believe now that you can accelerate not only the learning process, but the practical side to this. So you can get what used to take us, 5 years and however many classes and however much time it took to get to a certain spot. We think you can accelerate that now to just a matter of a couple of months by doing, a number of trades. And this is a great way to get there. Let's go next one. how do I determine a one standard deviation move? Well, standard deviation move is 68% of the distribution around the distribution mean. So to determine a one standard deviation move, we look at the 84% probability of being out of the money on both sides. We've talked about this 100 times, but just for, just in case, so it always gets clear. And that's why I explained those 40 earnings trades we made. We made 40 earnings trades last cycle. 6 and 6 would be the average on both sides, coming out to 28 or 68%.
So if you're doing a naked put or a naked call and you're not doing the other side, you're going basically to the option that has a 32% probability of being in the money.
No, you're going to the 84%. You're going to the 32% if you're doing both sides, only if you're doing both sides. So that's the mistake that a lot of people make. It's just,
perfect.
It's got to be somewhere in between. You have to figure out what works for you. All right, let's go to the next one. So how do you determine what is the significance of a two standard deviation move? This has been kind of my, this is like really interesting to me because for years as a prop trader, I couldn't define risk to our traders. So we'd hire traders all the time. In fact, there's a number of traders in that room that through over time worked for us. And I couldn't define, hey, don't take more risk than X. And we never were able to define it around a real number like you guys can define it today. So what's happened is with the new technology that's at your fingertips now and all the context in that technology, you can define risk in a way that we would tell a trader, hey, just don't lose money or don't take more risk than X. And I don't know what that meant. Now we're telling individual investors actually what undefined risk means. So, basically we look at that 97% chance of getting, that's where we define undefined risk. That puts some context around kind of all the risks that you take around even every binary event. And
that's what the brokerage firms use,
that's
right?
That's right. Let's go to the last one. So what is the market maker move? This is the expected one standard deviation move based on what's implied in the options. Why do the options matter? Because that's the only way to determine, when you have a derivatives market and somebody's willing to lay leverage on something, that's the only way to determine what something's really, what the value is. With no derivatives market, everything's black and white. With a derivatives market, if we created a derivatives market around everything, you could essentially, you would know
that you're overpaying for your insurance on your car?
Or something like that, or underpaying, whatever it is. Like I was with somebody the other day, they actually have a house in near Daytona, and they said, the insurance company canceled my insurance, their flood insurance. And I'm thinking to myself, but some other company wrote it. So the company I had before canceled the insurance because I made a claim, but then, or the person told me because he made a claim, and then he said, but some other company wrote the insurance the next day. And I'm thinking to myself, like, what are they thinking? Like, there's just a model. Like your business is writing insurance, right? So the model is if you think you wrote it too low,
raise the premiums.
Raise the premiums.
Raise the implied volatility.
Right. Sometimes I wonder about, when you sell a derivatives product, if you think you're selling your product too low, raise the price. And if somebody doesn't want to buy it, then you don't make the trade.
They'll either find some other place to go or they don't make the trade.
With traders, with markets like this, if you think you're selling something too cheap, you raise the price. If you think you're selling something, and that's it.
Now, how is that found in the open market? That's through supply and demand, right? I mean, that's basically from everybody's order that comes into the pit.
So there's never a lack of offers or a lack of bids because anything that's too cheap, gets bid up. Anything that's too expensive gets pushed down. And that's the whole objective behind, that's kind of the whole delivery behind trading for individual investors. That's why we're here. So this can be estimated two ways. You can use the implied volatility to calculate a one standard deviation move by taking 85% of the front month straddle, or you can take the front month at the money straddle and strangle and divide by 2. They're virtually the same thing, and it's already built into the TOS software. So you can do the same thing either way.